Hello and welcome. You're watching AAYC. I'm Harsh Saita, and today we're going to be talking about Paras defense. Now, the defense space in general was under pressure over the last week or so, and especially yesterday. But what we're seeing likely is opportunities, and we're trying to spot that, and we're trying to also see whether there's been order activity pickup in H2 or not. So those are just some of the factors we're looking at where defense is concerned. Also, some of these domestic defense companies are poised for very, very strong growth. Now, is it the growth at the right price is what we're going to try to assess today on AAYC. Let's start off with what I want to know first off with regard to Paras Defense in particular. Which products do they have no or low competition in? And what component of that product comprises top line? Because what you want to understand is what sets the company apart. That's exactly what we want to know. The second piece is the book to bill. This has been between 2 and 3. Will it continue to remain so as the revenue starts to pick up? Currently, the top line is 350 odd crore, and this is FY25, 365 crore. But as the revenue starts to pick up, can the order book size and the opportunity also start to pick up is what I'd want to know. So both of those pieces are important. Driving the defense engineering margins higher. Defense engineering margins have gone from 12% to 22%, and that has also led to the margin uptick that we've seen. Now, what is driving that higher is what I'd want to know, and how sustainable is that? Because what they've guided for is a possible upside even to the current margin from 27 to 29%. You want to know and understand as to whether that is sustainable. Mind you, you have a very, very critical percent margin. How sustainable is that, and how much is the government willing to allow that to happen? So all of those spaces we'll try and get a sense on. The fifth piece is new product launches, and within this space you have space camera launch, which they are going to launch, which is going to be a massive opportunity for them. I want to understand the size of that opportunity and how uniquely they are positioned to capture that opportunity. So all of those pieces. Also the drone camera, that's something that is a work in progress. Again, a very critical component to drones. In fact, a large component of the drone cost comes from the camera itself, and therefore want to know as to how large the opportunity is and how close they are with regard to launching the product. Competition across products is what I'd want to know, because if that is the case, then the opportunities obviously are lower. There could be import substitution, or there could be limit in terms of the way exports play out. So all of that also being put together. And last piece is with regard to key defense components, rather sustainability of margins overall, and lower why export margins are lower. All of those pieces is what I'd want to try and get a sense of. So plenty happening with regard to a Paras defense. Let's start off by understanding the company itself. Founded in 1979, it's a precision engineering firm. It's focused now on defense and space technologies. It's listed on the BSE NSE in 2021, and it's Mumbai headquartered. Now let me talk about products. It's got a very unique range of products in its product basket. There you go. Let's start off with the first one, submarine periscopes. Now this is unique. It's one of the only manufacturers, Indian manufacturers of submarine periscopes, right? Extremely unique product. You have certain cameras, lenses, rugged consoles, electromagnetic pulse shields, flow form tubes for missiles and rockets, anti-drone systems, including jammers, drones for surveillance, logistics, and quantum sensing for secure communications, and thermal management systems for electronics. So they've got this slew of product lines which they work across, a lot of which are super unique. Let's talk about the revenue mix. Optics and optronics is 53%. This is a better margin product, by the way. Optics is a far better margin product. And then you have defense engineering, where EBITDA margins have inched higher. But that's the split, 53-47. In terms of the book to bill, the split is slightly different. We'll come to that. Currently, 85% of the sales are tilted towards domestic, out of which 70 to 80% comes from the government. And then you have 15% with a tilt towards export. Now let's talk about manufacturing a little bit more. With regard to the manufacturing, the end-to-end design, development, manufacturing happens in-house at Paras Defence's facilities. Navi Mumbai and Ambarnath are the two facilities they have in Maharashtra, and then they have an R&D facility in Bengaluru as well. So that's broadly what the company does in terms of product, in terms of range, and in terms of where they operate from. Now let's talk about the metrics. We'll start off with the P&L. Again, very healthy set of numbers over the last 3 years. They've compounded top line at around 26%. They've compounded EBITDA at around 24%. And they've compounded PAT, again, at a very healthy 31%. So you've seen an uptick, a downtick, and thereafter back an uptick with regard to margins. So that's what you want to try and understand better. We spoke about that piece. Now let's talk about the margin itself. You can see the margin trajectory, the way it has picked up. You look at the slightly lower margin for Q1 and thereafter the lift in Q2. The full year FY26 margins are at roughly 27%. That's the guidance given. Now let's talk about the operational metrics, and some of these become important because you need to understand the book to bill. And the operational metrics currently in terms of the book to bill stands at 2.7 times, which means that you've got nearly a 3-year current top line visibility, but top line is going to grow very, very quickly. And therefore, this bridge in with regard to book to bill will shrink very, very rapidly. Let's look at also the book to bill over the last maybe 3 years or so, and you'll see the trend at around 1.8 times to around 2.5 to 2.7 times. That's really the journey with regard to book to bill that they've taken. In terms of the balance sheet, it's a fairly clean balance sheet. There's very little debt, excluding lease liabilities. The debt is just 56 crore, and that's the order book split, by the way. Around 550 to 600 crore is optics. So you can see 60% of the tilt is towards optics, which is higher margin. Coming back to the balance sheet, well, you've got a decent balance sheet. Borrowing is at around 56 odd crore. You've got cash bank balance of around 90 odd crore. And then you have equity and book value, which is roughly at 671 crore currently. This is a 5,300 crore market cap company. So it's trading at around 6 to 7 times price to book. Let's talk about cash flows now. In terms of the cash flow, you've got the cash flow from operations is slightly off. Cash flow to EBITDA is not exactly clean, and that's because of government recoveries which need to keep coming in. We'll also try and understand a bit around that as to how the recoveries are playing out. Let's talk about return ratios, and they've done double digit, but it's erratic. They've done 16% in the last year, but outside of that, they've done between 10 and 15%. So not the best, a fairly neutral stance where the ROEs and ROCs are concerned. Let's look at shareholding. Some bit of dilution from promoters, and you can see the shareholding standing at 53%. So nonetheless, promoters continue to hold majority stake, no concerns there. FIs, DIs certainly interested, but it's a smaller company. At 5,300 crore, the free float itself is around 2,500 odd crore, right? So you've anyway got a very low scope for that. Let's look at management guidance. They've guided for approximately 450 to 500 crore of top line for FY26. Higher value periscopes will start getting delivered in Q4 FY26. The additional order flow is likely to support FY27 growth. EBITDA margins at 27%. We spoke about that, will improve to 29% in coming years. Defense engineering margins have improved. FY26 end order book is expected to be at around 1,100 crore, and space camera launch is expected to be around in another couple of months or thereabouts. They're developing drone cameras, and they aspire to be India's only drone camera manufacturer. So that's a big positive. Some of those are key standouts. This is in terms of course, the forward-looking guidance, FY26, what the numbers will look like, and therefore it values it around 60 times price to earnings if this were to play out. Of course, those are just estimates. Management does not do commentary typically after every quarter. So this will be a unique conversation. You want to stay tuned to this conversation. We will speak to the management of Paras Defense on the other side of this very short break. Stay with us. Well, thank you for staying with us. We're talking about Paras Defense today. We've analyzed, or we've tried to give you the best picture, the best snapshot of the company very, very quickly. Now let's go across to Amit Mahajan, who's the Director of Paras Defense, joining us this morning to talk to us about what the future holds with regard to our Paras Defense. Amit, great having you. Let me start off by trying to get a sense, this book-to-bill ratio of yours of 2.7 times, do you maintain that even as you scale up with regard to your revenue? Because there is likely to be a strong scale up in revenue, right? I'll come to the numbers with regard to the revenue, EBITDA and PAT, but give us a sense of where the order book goes.
Firstly, Harsh, good afternoon, and I really want to thank you for having me on this show, one, and secondly, covering the company so well that I think I have very little to answer here because you've answered almost all the questions that you wanted to ask. Your question's quite interesting. The company has seen book-to-bill ratio very handsome and very strong. We've been able to maintain anything above 1.5 times, and this has been the best in the defense industry that you can ask for. And as we scale up with our revenues, we will continue to maintain this ratio. We are hopeful that it will always be in excess of 2 times or more, but 1.5 times or more for sure in the next 5 years that I can see.
Understood. And Amit, if I were to ask you, and because you've got such a strong book-to-bill, the predictability of revenue is very high, right? So give us a sense on execution. How does the execution game play out? You're currently at 365 crore in terms of top line. You've guided in your recent management or recent meeting with one of the analysts that you'll touch 450, 500 crore this year. Give us the next 2-3 years in terms of a roadmap. What's the kind of growth that you clock?
We will be able to grow at a pace of 30% or more, and the growth comes primarily from we going up the value chain with our product line. So when we are moving up the value chain with our product line, the capacities that we have currently are so scalable that we have a very established supply chain. We have all the designs with us, and these are orders which are repetitive in nature. So we should be able to deliver in our existing capacities a much higher. For the next 3 to 4 years, we don't see any capacity constraints from the resource point of view. The financial position of the company, like you rightly mentioned, we are completely debt-free, and the kind of financial reserves that we have, we should be able to not only justify the growth, but we should be able to even catalyze this growth. Whatever I'm telling you as 30% can look as conservative moving forward.
Got it. Where does the growth come from, Amit? Currently, your order book is skewed towards optic. Does it continue to come from there? And I ask you this question because your optic margins are far better than your defense engineering. So I'll come to defense engineering in just a bit, but does the order book continue to tilt towards optic? And how good are the optic margins versus the defense engineering? For our viewers, give us a perspective.
So the order book is always skewed towards optics because optics are slightly larger turnaround time orders. The defense engineering orders, they come in late and they get executed faster. So if you see, although the optics order book is heavier than the defense engineering, the revenue mix defense engineering is heavier than optics. However, moving forward, looking at the opportunities that we have for the next year and the subsequent years, they are tilted towards the optics and optronic systems, and hence the margin uptake we expect to happen significantly. Whatever margin guidance or whatever margin past history we've been having, we're having that with 40 to 45% of revenue contribution by optics. Now, the moment every percentage of revenue increase that optics does is going to positively influence the margins of the company. So looking forward, I'm hopeful that we come closer to 50% revenue from optics and optronic systems.
By how much does it increase your margin? You've guided for 27% this year. By how much does it go up with every percentage change in optics in the revenue mix?
We are hoping that we cross 30 and we are in a comfortable position from there.
How quickly do you get to 30?
I would like to believe that it is happening this year itself.
In this year itself. Okay, that will be a loud statement. Okay, got it. So that's my headline, Amit. Anyway, okay, if I were to go back and try and get a sense on defense engineering, what's led to that margin increase? That's a very substantial margin increase you got there.
So defense engineering is one area that we tread with a little bit of competition. Although Paras likes to tread in areas where there is no competition, but defense engineering is a legacy business for us. It comprises of defense electronics, electromagnetic pulse protection, and mechanical engineering. So these are areas which have been the nucleus of our company, and they are a little competitive in nature. But in here as well, our teams have been creative to find and develop systems which are unique in their performance, in their capacities, and at the same time, the change in nature of business, which is more of larger quantities and moving from a development centric defense industry to a production ready defense industry. This is the reason why even a competitive business, there is going to be an uptake in the margins. So that is the effect that you're seeing happening on our margins on defense engineering.
And Amit, give us a sense. You are going to bring in a slew of new products. The space camera is one of them. The drone camera is the other one. These are unique products, unique to you, especially from an India perspective. What does this do to your top line? Does it only give you upside, or is it already built into the 30% guidance that you're guiding for?
So the 30% guidance does not include these because, see, when I'm looking at my projections for the next 2 to 3 years, I am looking at opportunities which I have not just are talking to the customers, but we have bid for, and we have a very strong chance of getting that particular business. When I'm looking at these space cameras, and when I'm looking at these cameras for UAVs and drones, these are opportunities that I'm working for. The very fact that we are the only company working in these domains, the opportunity funnel becomes clearer and clearer every month. Now, the size of this opportunity is humongous. And if I have to embed this into my uptake or my revenues, then I will not do justice to 30%. 30% start looking very, very meager growth. But if you look at these opportunities, the way they will come spaced out, we hope they come spaced out in a linear fashion and not exponential. It will be an exponential growth if all of these opportunities have to become active at one particular time.
Perfect. Amit, I'm out of time on this one, but this has been a very, very interesting conversation. It leaves us, clearly with a roadmap on what Paras is up to, and probably gives viewers a very, very good insight with regard to what to expect from Paras Defense going forward. Viewers, if a 30% top line were to continue over the next 3 years, FY28 will likely mean that Paras Defense clocks a top line of around 850 to 900 crore, if I've done the math right. And with a 30% margin, if that were to come through, could well be something like 250 to 270 crore in terms of EBITDA. And that changes the game substantially from the current 120, 125 crore EBITDA that we are penciling in for FY26. Just doubles EBITDA in the next 2 years. Something you want to watch out for, of course, as it plays out. But Amit's left us with many, many thoughts. So I hope that this has been productive for viewers. Of course, stay with us here on ET Now, but that's all the time we have on this edition of the show.